calculation of net present value and internal rate of return. The definition of net present value is the sum of the present values of all cash inflows minus the sum of the present values of all cash outflows. In the net present value, the time value of the money is used to appraise the long-term projects. To identify the time value of the money, we are using the discounting rate, which brings the future cash flows to the present value. NPV is helpful to measure how much value or wealth an investment adds to the organization wealth. This explanation of wealth maximization makes the NPV as a very attractive tool to choose among the projects. Now we shall see the steps to find the NPV. The first step, we have to identify the cash inflows in the future and the cash outflows in the initial period and in the future also. Second point is we should identify what is the cost of capital for the firm. As third point, using this cost of capital, we have to discount the cash flows and find the net present value. Here the cash flows may happen not only in the initial period of the project, but in the later period of the projects also it may happen. When there is a cash outlay in the later period of the project, then it should be suitably discounted and brought to the present value. In the net present value calculation, the discount rate plays a major role. We shall slightly understand how the discount rates are decided by the firm. Normally, the firms use the after-tax weighted average cost of capital as their discount rate when their capital is mixed with debt and owner's capital. Sometimes the rate at which the investment can be made in different projects may be taken as a discount rate. In some cases, the real reinvestment rate of the firm can be taken as discount rate. The discount rate is also called as weighted average cost of capital, rate of retained earnings, rate of capitalization, cost of capital, and target rate of return. When we use the NPV as a decision making tool, as we previously explained, the net present value will show how much wealth will the firm get due to the project acceptance. So if the net present value is more than 0, there will be certainly an addition to the wealth of the firm, so we can accept the project. If the NPV is less than 0, we can reject the project. If there is a choice between two or more than two mutually exclusive projects to be taken, we have to select the project which gives higher NPV. In the context of net present value, we have to understand what is mutually exclusive and independent projects. If there is a scarce resources and we have to choose the best project among the alternatives available, it is called mutually exclusive cases. In this case, the project which gives more NPV we have to select. If the projects are independent and there is no restriction on the resources, we can select all the projects if the NPV is more than 0. If the NPV is less than 0, we should reject the project. If the NPV is equal to 0, we have to use some other criteria to select the best project. If the life of the different projects are unequal, the net present value method cannot be directly applied to make decision. We have to find modified net present value with the help of equated annual cost or equated annual benefit, as the case may be. Now we shall understand the net present value with the help of a simple problem. See, the managing director of a smart Xerox and scan company is thinking of two mutually exclusive projects for his company. Designing of a machine with printing and faxing option. The second project is designing of a machine with options of printing, scanning, faxing and Xerox. After the designing, the company is planning to manufacture 50 machines of any one of them and provide the same on rental basis to various users. The rent will be decided based on the usage of the machines at the client's place. All machines in a particular user's place will be linked with a server which will be accounting the usage details of the machine. To facilitate this accounting of usage, the smart Xerox and scan company has to install a computer device which will be recording the details. The cost of each such device is 25,000. There will be a need of 10 such devices for both the projects. As per the income tax provisions, the computer device is fully depreciable in the year in which it is put to use. All these devices are installed at the year 0. Taxation 33%. Comment which project should be selected and why. The rate of capitalization of the company is 16%. There is no salvage value for the computer device at the end of the project. The additional cash flows of both the projects are as below. In the 0 year, there is an expense for exclusive development expenses, 1 lakh for project 1 and 1,65,000 for project 2, and for 6 years they have given cash inflows after tax. Now we will see how to find out the net present value. See, first we have to define the columns: year, description, present value factor at 16%. 16% is the cost of capital here. For project 1, cash flow after tax, and we have to identify present value for the project 1. The same way we have to identify present value for project 2 also. In the first description, in the 0 year, installation cost for 10 numbers of computer device into 25,000 each. The present value factor will be 1. So the total cash flow after tax, that is outlay, is 2,50,000. The project 2 also same amount is coming. Next, the development expenses for project 1 it is 1 lakh and for project 2 it is 1,65,000. As far as the depreciation is concerned, as per income tax rules, the computer device is fully depreciable in the year in which it is put to use. All the devices are put to use in the 0 year. So normally income tax savings we will get only at the year end. So on the depreciation of the computer device, we have calculated 33% as tax savings. For that we have to multiply with year end, first year end present value factor, and we are having 1 to 6 years cash flow after taxes, and for this also we are identifying present value. Now the net present value of the project 1 is 25,781. This we have calculated by totaling the net present value. How we have found out? There is a cash outlay to the extent of 3,50,000 in the 0 year, and we are having present value of cash inflows to the extent of 3,75,781. So we are reducing this, the cash outlay, from the present value of the cash inflows. Then we are arriving 25,781 as the net present value. Same way we are identifying net present value for project 2 also. We are having 30,723 as net present value. So based on the net present value, because net present value is showing how much wealth maximization can happen to the organization. So when we are seeing the net present value, project 2 is giving more net present value to maximize the wealth of the company. So obviously we have to select project 2. Okay. Here, if we see without the time value of the money, we may select a wrong project. But when we are applying the time value of the money, we opt Xerox, printer, fax and scanner project as the best project. To view in isolation, both the projects are adding wealth to the firm. If it is not a mutually exclusive case, we can accept both of the projects. But in the problem, they have clearly told it is a mutually exclusive case. So any one of the project only we have to select. So the criteria is the project which gives more net present value should be selected.